Most people are completely confused about what is required to achieve financial success. If you ask them to write a list of the most important factors to determine whether an investment program will succeed, they will almost certainly prioritize CNBC fables like clever stock picking and knowing when to buy or sell. In reality, these ideas are more likely to guarantee your failure than lead to success. The decisive factor for long-term success is an ability to overcome the neurotic impulses that will frequently occupy your mind over the course of an investing lifetime. Now may be the time for you to fire your certified financial planner and hire a shrink. The democratization of financial wisdom is one of the great benefits of our modern age. The data necessary to create a successful long-term portfolio has been widely broadcast across all media. Anybody with average intelligence and an internet connection can investigate the matter for themselves. All humans suffer from the need to prove how clever they are, so we love to nibble around the equity edges. But a fundamental truth is known. The overwhelming majority of people should simply buy and hold an inexpensive, broad-based U.S. stock market index fund. Once you and your money commit to this fundamental truth, all that you need to do is not screw it up. And this, unfortunately, appears to be more difficult than most can manage. I have always suspected that the biggest risk to people's portfolio is in their head, but I was too busy trying to overcome my own insanity to save my neighbors. I retired 6 years ago and occasionally spend some time trying to understand exactly why so many people struggle with this topic. Long and sometimes very difficult conversations with close friends supported my initial suspicion. I am no scientist, but I do understand that anecdotes are not the same as data. So I did what anybody with average intelligence and an internet connection would do. I looked for the data. One of the most concise and damning reports to cover the issue is Dalbar's quantitative analysis of investor behavior, the QAIB. Dalbar is a research and consulting firm that evaluates investment companies, registered investment advisors, broker-dealers, and other financial professionals. The QAIB is an annual report that measures the effects of investor decisions to buy, sell, and switch into and out of investments over short and long-term timeframes. These effects are measured from the perspective of the investor and do not represent the performance of the investments themselves. This is a critical distinction. Most analysis you see is focused on a specific fund's performance. For example, there is no shortage of websites that will show you the 1, 3, and 5-year return of a specific mutual fund. But the fund's return is often very different from the investor's return. The Dalbar report shows that the average investor earns less, often much less, than mutual fund performance reports would suggest. This begs two questions. Why do most investors earn less, and how much less are we talking about? Let's start with how much less. For 2021, the average equity fund investor finished the year with a return of 18.39%. That is versus an S&P 500 index return of 28.71%. That is an investor return gap of 1,032 bips, which is more than 10% for those of you who don't speak bips. FYI, bips is slang for basis points, and there are 100 basis points in 1 percentage point. In 2023, the average equity fund investor finished the year with a return of 20.79%. And that again is versus an S&P 500 index return of 26.29, an investor gap of 5.5%. Now, not all years are this bad. but a review of historical data shows that the average equity fund investor does not keep up with an investor who simply buys the index fund and has the mental fortitude to endure the long and winding journey. Buy the ticket, take the ride. Now let's discuss why most investors fail to earn the same return as the funds they own. The simple, if painful truth is that most investors do dumb shit when under stress. Historically, the average investor has failed to realize the long-term benefits of asset ownership because they do not stay invested in any given investment for a long enough period of time. According to Dalbar, the goal of QAIB is to improve performance of both independent investors and financial advisors by managing behaviors that cause investors to act imprudently. The report states that the best financial professionals double as behavioral finance coaches. When markets are down or volatile, questions will arise from concerned clients, and perspective will be needed. The report gives advisors the tools to tell a story, put things into perspective, and deliver the calming messages that are needed to mitigate return-destroying behavior. Dalbar tells its clients to offer their investors calming messages, such as the importance of investing assets as early as possible, the prudence of a long-term buy and hold approach, awareness of common behavioral influences, and, of course, lessons learned from past markets. I agree that calming messages and historical perspective are important tools to prevent an investor from making a horrible decision to sell at the bottom or switch from one fund to the next based on the latest Morningstar rankings. If the market is down 20% and you begin to suspect that it is a good idea to sell it all and buy a goat farm in Nicaragua, you should probably step away from the computer and go for a walk. The report briefly addresses one of my favorite topics, the abject failure of active managers to beat the index over time. Comparing active versus passive strategies, the report notes that investors in equity index funds experienced a far smaller return gap than their active equity counterparts. For 2021, the average equity index fund investor earned 23.44%, which is 527 bips lower than what the index returned. A 5.27% gap is considerable by historical measures, but this was approximately half the gap experienced by the average active equity fund investor, who underperformed the S&P 500 by more than 10%. This means that the average but emotionally unstable index fund investor underperformed his index by 5% because he got in late or sold out early or some such thing. But the average emotionally unstable active management fund investor underperformed by 10%. Why the double negative results? My theory is that the results are twice as bad because you have twice the number of people involved, and therefore double the psychological baggage. You have a neurotic investor being escorted by a delusional money manager. It is a psychiatrist's nightmare. The investor is scared and wants to pay somebody to tell him it will all be okay. Meanwhile, the delusional stock-picking money manager struggles to justify his very existence by maintaining the happy fiction that he provides some kind of value, even though no data exists to support this notion. Even Sigmund Freud would struggle to sort out this kind of a mess. In the end, these uneasy souls flop around like a fish on the dock, selling, trading, and then buying again, doing exactly what they should not do. I will finish where I started. All the data supports the proposition that successful investors must start young, buy the broad index, and then do whatever is necessary to not screw it up. One solution is to hire a financial planner and pay him a percentage of assets under management. He or she will absolutely not increase your rate of return. That silly argument has been disproven by years of data from Dalbar and everybody else who looked at the numbers. But maybe your CFP will do you a favor and ignore your call when the market is down. Or maybe he will take your call and then, in a very serene and smooth voice, read to you from the Dalbar Calming Messages memo. Do not sell in a panic. Do not sell in a panic. Maybe it will work. Maybe not. One thing is sure, it would be cheaper to hire a psychiatrist. You can put one on retainer and then schedule weekly visits whenever the market is down by more than 10%. When times are good, you may not have to schedule a visit for many months. Whatever works. Just don't screw it up. That's all for now. Please remember to like and subscribe and hit the notification bell. Take care.